Hi, everyone. Thank you so much for joining us today. Today, we're going to go over the fourth quarter of 2022, what happened from October 1st to December 31st. We're also going to go over inflation and possible recession, as well as what that means for investors. So what happened in 2022? Energy price shock from Russia and Ukraine war. We had high inflation and we had large central bank rate hikes. Fed Chair Jerome Powell is on track to deliver the most aggressive rate hikes since Paul Volcker back in the 1980s. Market expectations are that the Fed funds rates will go up to about 5% by March 2023. Against this, there were few places for investors to hide as stocks and bonds delivered double-digit losses in 2022. Let's put that behind us. Federal Reserve did raise interest rates 7 times in 2022, bringing the Fed funds rate to 4.25 to 4.5 from 0. This is the fastest rate hike since 1980. And the pace of the interest rate hikes led to the worst year in history of the bond market since the inception of the Bloomberg US Ag Index that started back in 1976. Also the only time for 2 consecutive years of negative returns for bonds. Another big component was inflation. It was the center stage for markets and the economy in 2022. A little different story in 2023. We expect headline inflation to slow, primarily as the goods-related inflation due to supply chains catching up and the demand reduction has slowed down. However, service inflation, which tends to be a little more stickier, still going up. And this inflation, it's higher than what the Fed wants as a target of 2% inflation in 2023. 2 key components of shelter are wages and shelter. Based on the Atlanta Fed wage tracker, it appears wages they've peaked and potentially begun to slow down or cool down. On the other hand, shelter component with inflation it's a 12-month lag to falling home prices. Home prices began to slow down in the second half of 2022. We estimate that the shelter component with inflation should provide some relief starting around Q2 in 2023. Right around April, May, June of 2023. Historically, growth has slowed 12 to 15 months after the start of a hiking cycle. The starting point of the economy today, with the healthy balance sheets of households and corporations, they lead the economic slowdown. So it's not going to be as bad as recessions in the past if we have one. Looking at every rate cycle, greater than 3% shows that while every instance of the rate hike has led to economic slowdown, it doesn't necessarily lead to a recession. Rate hiking cycle of 1961, 1992, 2003, these are examples where the economy was able to slow down without actually stalling. One of the reasons is the resiliency in the labor market. Today, the job openings to those seeking jobs remains at an all-time high. This tells the Fed, move to slow the economy. It could erase some jobs without actually increasing layoffs or unemployment. In addition, the healthy balance sheets of households and corporations, they remain strong in comparison to the past economic recessionary periods. Regardless, it's important to acknowledge probability of recession has increased given the challenges that lay ahead in 2023. The starting point of the economy does make us hopeful that the slowdown should not be as severe as ones in the past. Bonds, they are looking better, in part because the correction of the bond market was more extreme than experienced than the equity markets or in the stocks. Bloomberg Ag declined about 30% during the year in 2022. The good news is the yields rose across the board, so that's the silver lining. Yields across a variety of different bonds rose significantly to make bonds once again attractive and not a bad defensive stool within investment portfolios. So the US bond index yielded 4.7 by the end of 2022, compared to 1.9 at the beginning of the year. The additional 2.6 yield should fill that 13% loss in about 5 years, assuming yields remain stable. With the most anticipated recession ahead, investors are wondering, is it all bad news in the equity markets? Looking at the S&P returns around recessions tell us that the average peak to trough decline is roughly down 29%, which could mean further pain in the near future. In addition, historically, stocks have never found their low before a recession has ever started, which could spell added volatility in the near term. However, stocks also tend to bottom before the recession is over. The initial snapback tends to be sharp. Investors should remain cautious in the near term. It's important that investors do not try to time the market based on the economic data either. So probability of a recession 2023 is high, and recessions are painful, but they do tend to be around not too long. On average, they last about 10 months. Keep in mind, recessions are part of the economic cycle and are needed to remove excess from the economy. This sets the foundation for future growth and provides opportunity for investing for longer-term results. Waiting for the economic to recover could be a little bit late to invest. Stock market is always forward-looking and tends to lead the economy, especially in turning points. Historically, the stock market peaked 7 months prior to the economy peaking and started to rebound about 6 months prior to the end of the recession. Some of the best gains to come forward are in the next few months of the market recovery and tend to provide opportunities across a variety of companies, industries, and geographies as each transitions into a new cycle. So to recap, in 2022 is the only time in history since 1926 where stocks and bonds fell more than 10%. Doesn't happen very often. The worst of inflation is behind us. Rapid interest rate hikes have taken a toll on the economy. While resilient so far, the risks of a recession have increased. Investing landscape will remain challenging in the near term. Good news is that bonds are paying more attractive yields and offer a good strategic play on the defense. Thank you so much for watching.